Hey guys, this is Terry with Futures.io. It is my pleasure to welcome Piers Curran of Amplify Trading for today's webinar, Politics Trumping Economics, How to Trade Asset Price Volatility Created by Political Risk. Now the bullet points for today's webinar are Trumpflation. Can the equity rally continue or will rising yields and greenback appreciation halt momentum? Brexit. As the UK starts to negotiate an exit from the EU, how will this impact on global markets? And European elections. French and German election uncertainties. Can Le Pen really win? Can Merkel really lose? Now, during the webinar, please feel free to type your questions into the questions box, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar, and as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. You can follow us on Facebook, YouTube, and Twitter with @Futures.io. And without further delay, I'll hand it over to Piers.
Okay, hi, yes, Piers Curran here, tuning in from the Amplify trading floor here in London, UK. Thanks for joining me. Just to give you a brief very brief intro into who I am, just so you can kind of get a feel from what kind of experience level I'm talking from. I'm the head of trading here at Amplify Trading. We're a proprietary trading firm based in London, as I said. We've also got a kind of secondary arm to our trading firm in that we've created a lot of bespoke technology that helps to teach people about markets. We do a lot of work with investment banks and asset management firms and universities and so on. So I've been a trader for 16 years. If I just move my screenshot and change it up to my charts, this is the kind of stuff that I'm looking at on a day-to-day basis.
Piers, you should have the pop-up to share your screen. You're not sharing at the moment.
Okay, just let me share my screen, guys. 1 second.
There we go.
Okay, so can you see my, actually I'll bring that screenshot back in showing,
yes,
well, showing myself. So yeah, this was just what I was showing you. Now that you can see my screen, I'm going to pull that away and I'm going to show you my chart. So this is what I'm looking at on a day-to-day basis and have been for a number of years now. I trade across asset classes, mostly on exchange futures. So I'm looking at equity indices, I'm looking at FX, I'm looking at commodities and bond futures. And we trade mostly very short term, looking to exploit intraday volatility. I would describe the way we create our kind of trading strategies as using a combination of looking at the macro fundamentals and then combining that with a technical process to build trading strategies and to manage our risk. And so, you know, the topic of today's conversation, and actually just as I'm kind of talking, it's good timing here because we are getting some pretty steep downside in some of these equity markets. We're getting some pretty steep upside in some of the safe haven markets, and I'll talk through these in turn. But I would say we've had a pretty uninteresting period on the equity side for the last couple of weeks. If we just start with, let's say, the S&P 500, and when I say uninteresting, I'm going to go to a daily chart and I'm going to just zoom in a little bit on what's happened this month, let's say in the month of March. And actually let me zoom in a bit. I'm going to go to a 4-hour chart to get March a little bit more defined. And so this is the month of March, and we did have a big move higher at the beginning of the month, which was Donald Trump led. And so, you know, the topic of this kind of discussion today, if you like, is politics trumping economics, because I would say from the macro side, you know, it's definitely the situation that right now you need to be more of a political expert than an economic expert often to understand why asset prices are moving and therefore to be able to trade that movement. 1st of March, big punch higher for US equities, new all-time highs, of course, and this was off the back of Trump. Finally, having been inaugurated end of January, finally, it took him till the start of March to actually start talking about his fiscal plans. Those plans were absent from all of the chat coming from the White House up until that point. His policy efforts up until March were mainly centered around, of course, building his wall, signing off on the Keystone Pipeline, delivering immigration ban on 7 different countries, all this kind of talk, and nothing on fiscal side. And then he started to talk this up in the start of March, and this is what markets have been excited about, because ultimately if we very quickly move back, and I will get on to what's going on right now, you can see in fact, you know what, let's forget about the longer term and just talk about what's happening right now, because this is actually probably, as you can see on this chart, for sure the biggest sell-off we've seen this month. If I go to a daily chart, then actually in terms of red candles, we'll see where we end up today, but right now we're testing the low point. We're testing the March the 9th low right now. This is a key technical price point, the low being at 23.54 on the S&P 500 futures. This is the biggest sell-off. Look, I'm looking on this daily chart. I don't know, maybe you've got to go back to actually, maybe this is the biggest sell-off this year actually, right here as I speak. So let's talk about why before we look back and think about the longer term and think about Trumpflation. So I'm going to go back to the 4-hour chart. I mean, what's going on here? And it's a bit subtle. It's not actually triggered necessarily off a specific headline. I would say what you've got here today is people beginning to just drift into that camp of being a little bit skeptical as to whether or not equity prices are justified at these all-time highs. It's only marginal. Although it's the biggest sell-off this year, we're still within the range we've seen in March. So let's not get carried away here. You know, ultimately, if we broke 23.51, which is that March low, well then fine, this looks a bit more interesting technically on the downside, and there would be some pretty decent open space for this market to drop into. 23.51's key, but we're not there yet. So why are we down here? Well, I'd say it's probably you know, focusing on the developments on the political side yesterday in the US regarding Donald Trump, of course, and the not particularly surprising revelations that the CIA are now investigating officially the involvement of Russia and the Trump camp in terms of was there any foul play regarding manipulating the election result. They've also, of course, rubbished the idea that Trump's claimed that Obama tapped Trump Tower, and they've rubbished that. So you're definitely getting this scenario, a bad day for Trump, let's call it. And why is that bad for markets? Well, you've got to look at why markets are at all-time highs in the first place to understand why what's happened, let's say, over the last 24 hours is now leading to equity prices dropping. And by the way, it's before I talk about why, let's just look at some of these other markets, because it's definitely not contained to the equity space, although that's probably, well, no, it's not contained to the equity space. I'm just seeing oil as well break lower, so we're now getting a move to the downside in crude oil. That's perhaps unrelated, but we'll talk about oil later. But it's definitely what we call risk off here for sure. On the left I've got the DAX middle left chart. That's the DAX, the German stock index, which took a while to get going on the downside. I have to say the S&P's been selling off for a decent period now. The DAX has only really just broken and driven down to test 1200, so Europe's now joining in on this risk off vibe. But you've got big upside on safe haven markets. Let's check 2 of those. Here's gold. Key break today of that high point we had yesterday, which was just above the high from the end of last week. So this is punching up through and trading up above 1240 on gold now. This is important. Look at the daily chart. We've got, well, we're kind of climbing back and recovering the downside we've seen back end of February and into the start of March. Certainly the key target on the upside for gold for sure is the high of the year at 1265. We've got plenty of work to do to get anywhere near that, and I would say perhaps the head and shoulders risk, if today's high stays in place, well then you've got the left shoulder from the 8th of Feb coming in at 1244, and perhaps we've just flirted with that. If you get a close, let's say, below yesterday's high, that might look pretty bearish in terms of a head and shoulders, but we'll have to wait and see. That's just the technicals, of course. At the moment, it's the fundamentals that are shaping things. Now, gold on the upside as funds flow out of risk and into safe havens. Check out T-notes, 10-year government bonds here, also climbing higher, and this is a decent movement. And when you're looking on the daily chart for T-notes, very, very consistent in terms of its range over the last 4 months. Quite clearly you can see the top side the multiple times, anytime we've gotten up above, the mid 125s, it's been key resistance anywhere around the 2.5, 2.6 kind of yield handle is key, and on the downside we've got this range defined by the December low and then the low of the year that was set a couple of weeks back. So certainly climbing back into the middle of the range here. So definitely a strong risk off, probably the strongest risk off we've seen in 2017. On the currency front, you've definitely had some dollar weakness. This is euro dollar top left. We climbed up through that high point that we had last week, up through 108.31, and today, this is the highest we've been for some of these currency markets for a while. Because if I just extend this on a daily chart, this is important. That's a new high for the year on euro dollar, and we've only got that spike high on the 8th of December. Preventing this market from making a 5-month high and getting back to kind of levels we haven't seen since the election, of course, back at the start of November. So definite dollar weakness here. You've also got some euro strength in this mix because we had some movements on the French election overnight with a televised debate between the presidential candidates, which saw a guy called Macron perhaps come out the winner, and that is a positive thing for risk. All that, from a financial markets point of view, all that we're interested in is Le Pen going to win or not? And Macron maybe marginally edged the chances of Le Pen winning lower last night. So a bit of euro strength in there. Check out cable, sterling versus the dollar. Again, big upside today, but actually most of this upside came this morning and has zero to do with the US dollar. We'll talk about this a bit later also. This is mostly about the inflation print we got earlier this morning from the UK. And this is the story of the global situation at the moment with inflation. By and large, we're getting inflation prints that are higher than expected and multi-year highs. And so sterling's ramped up off the back of this to test the 125 handle. All right, look, that's a very quick kind of rundown of what's happening and what I'm looking at and which markets I would consider to be the most important. So let's continue. Sorry, let me turn down my score. So let's just have a think about, well, why are we getting the risk off? Because as I said, it's slightly subtle, I think. Obviously, it comes down to, certainly from an equity point of view, why are we up here in the first place? And this is about, of course, the Trumpflation trade. Certainly, if I just check on, let's go to that daily chart again for the S&P. It's been a clear one-way journey since the election back on the 8th of November, 8th, 9th of November. Obviously big move to the upside as a result of that, and that's entirely due to this Trumpflation trade. It's the idea that, of course, Trump, with a Republican Congress, can actually deliver some fiscal stimulus packages that can really drive an acceleration in growth, that can in turn drive an acceleration in inflation, and that can, significantly benefit corporate America. Let me show you a couple of, well, let me show you a slide since we're on Trump here, and we'll come and talk about the Fed shortly. But here's a slide that quite nicely, and this is, I've pinched off Deutsche Bank, but this quite nicely sums up the situation in terms of Trump policy. Firstly, what are his policies on the left? And then secondly, on the right-hand side, what has he so far done about them? The top three here, fiscal stuff and regulatory reform in the financial sector, the top three items are certainly potentially very positive for risk. Sorry, guys, just give me 1 sec. I'm going to minimize my charts from behind. Sorry. No. All right, don't worry. Sorry, guys. I'm just going to change something up here. I've got a plan. So I'm going to do it in a different way. And it's not going to work. Anyway, I'm going to carry on. So here's a look at those policies. As I said, the top three positive. So this is all, I'm not going to go through these, this is old stuff, everyone knows about this. That's his, firstly his infrastructure spending plan. I would say everyone knows about it, but we haven't really heard much on it, I have to say, but yeah, I know. So I'm not going to talk about this in detail. Spending 2 to 3% of GDP on infrastructure, obviously that, well, in theory is positive for GDP, although whether it's going to create any new jobs is highly debatable given that employment levels are back to kind of pre-crisis. What is interesting and certainly powerful for the S&P and corporate America, of course, is the proposed corporation tax cuts, plus this idea that he might give these companies a one-off ticket to repatriate foreign profits at 10%. I mean, that could be huge. He hasn't really spoken about that. Then, of course, some tax cuts on the personal side, thinking about cutting the top rate of tax, repealing the estate tax. With regards to the regulatory burdens, well, of course, trying to repeal Dodd-Frank. You know, all these are potentially hugely positive. The idea is with a Republican Congress, he's just got a much bigger chance of getting this stuff through. But what has he actually done? Well, I have to say, not too much, and perhaps. And if I go back to the charts now, well, what has he done on the fiscal side? And this is why we rallied in the first place. And I said at the 1st of March, right, he started talking about fiscal again, and we punched higher to new highs. But now we're selling off. And in fact, as I speak, we're now making a new low. In fact, I'm just going to zoom in here on this S&P chart because this is an important test, 2351. This is the 9th of March low. Any downside here below this point, the next support level would be the February 24th low down at 2345 on the June future. So key test technically, low of the month here. But what I was going to say about the CIA situation that was delivered yesterday, and perhaps if I show you a graphic, the reason why we're a little bit concerned about this is because basically it's a distraction. Let me show you something. This is like, and I realize the guys on Trading Live can't see this, but I'm going to carry on anyway. This is well, I guess you would say a Gantt chart. It's a timeline for what Trump might do. This is Goldman Sachs delivering this analysis, by the way, and they're trying to pick out, right, over the course of 2017 and then Q1 of 2018, what's the expected timeline on some of these policies that Trump's got up his sleeve. And what we're worried about is basically as time goes by, the Trump administration seemed to just be fighting fires. You know, there's new scandal, there's new attacks from left, right, and center, which is occupying a lot of their efforts, and that's time and effort that's not being spent on the more important stuff. So we've got timelines here. You know, perhaps also the priority from the administration point of view is thinking about repealing Obamacare. And that's expected to, you know, people are worried that's going to take a hell of a lot longer than is expected. Then look at the timelines with regards to tax reform. You know, if that does get going, let's say in Congress, if a bill gets drafted and it gets into Congress, let's say in June, it could take until the end of the year before that gets out the other side and actually we have some kind of new law created. And the risk is, well, A, that's a hell of a long time, and B, by the time it comes out of the other side, what will that look like? Will we get a tax reform that is a lot less significant than Trump himself, of course, is trying to make us believe when he uses the words enormous and amazing and sensational to describe his tax reforms? Well, fine, that's what he thinks, but what's actually going to be delivered? Well, Congress will say, and that might not be until the start of next year. So the point about, I would say, the risk-off we're seeing now is about another distraction. So we've just had a break, new low for March. This is another distraction, and it's quite a big one with regards to an official confirmation that the CIA are investigating Trump and his involvement with Russia in terms of trying to rig the election. You know, this is just further delaying what we see is the reason why markets are up here, and that's a full delivery of his promised tax reform. So definitely some decent downside. 23.45 next up. I'm going to go to a daily continuation chart on the S&P just to show you one thing that's important. On the daily continuation, we are now the lowest we've been since the 21st of February. I would say technically this is key. This is highly important. I would say properly on a technical basis, 2300's next up. Obviously that's a long way from where we're trading, but it may be as we track through the coming days and weeks. If you continue to see news flow dominated by Trump and scandal rather than Trump and policy, then these equities are vulnerable. All right, there's something else in the mix then. Obviously Trump's key, and they're definitely top of the agenda for global investors as we track through this year for sure. And the uncertainty with Trump, I'd say the big thing is the range of potential outcomes. Well, are just almost unprecedented. Right from Trump actually doing a good job and delivering rapid growth to the United States economy, right the way through to, I don't know, a global trade war, right the way through to even the more radical, Trump getting impeached and it leading to political chaos, of course. So the range is huge, which what makes the uncertainty all the greater. On top of this, and if you're outside of the US and if you're living in Europe and if you're especially living in the UK, well, it's not just about Trump, although that is a big factor when we're sat at our trading desks. It's about Brexit. This is the UK's decision to leave the EU, of course. And I've got a few charts here, a few graphics to show. Those guys are tuning in from the US here. You'll be able to see this. This is just a few graphics looking at a few different metrics with regards to the UK economy. And what we got top left is something important, and this is the inflation projections. This is Bloomberg's inflation chart. That's UK CPI year on year, and obviously we've had a steep upside as we've begun 2017, as is the case in most other territories, and a lot of that, of course, is as a result of the sharp rebound we've seen across the commodity spectrum, lifting inflation higher. But then with the UK, there's a separate issue helping to drive this, and that's the sterling devaluation we've seen since the Brexit vote. I'll show you the chart in a minute. Just to put that into perspective, the collapse in the pound that we've seen since summer of last year. I also want to show you what happened this morning. I'm going to take that away and I'm going to show you, well, let's just show you that cable chart on the weekly basis, because I want to make sure you understand on the long term what's going on here. This is sterling versus the dollar, middle of last year, collapsing to the downside, breaking through the 20 or Feb 2016 low and collapsing to a new 35-year low. We then went again October, big step lower, and 120. It's a huge price point for sterling against the dollar. Today we've had some upside, some pretty sharp upside, and that's actually as a result of this chart here, where we got some inflation data delivered from the UK this morning. So this is inflation update for the month of February, came in at 2.3%, above the expected 2.1%, above the all-important 2% handle, which is the Bank of England's target. This just shows a continued, well, almost exponential climb in inflationary pressures. This is a big problem. Why? Well, let me take you back to those slides, or the slide looking at the charts of different things here, because if inflation's starting to really ramp higher, well, look how it's having an effect on, look at the bottom left chart. This is retail sales, or I should say consumer spending, sorry, in the UK, and we saw a big drop at the start of this year as prices of goods start to rise sharply. Let's consider the top right-hand chart, which is looking at wage growth. This is over the long term, and whilst we've been pretty benign on this, it was looking quite interesting towards the back end of last year as we climbed almost back to 3%, which would have been matching the 2015 post-crisis high, but just again over the last couple of months, wage growth has dropped back lower, back to 2.3%. That's disappointing. So there's signs of weaknesses when you're looking at gauges of economic activity, bottom right. So in February, as inflation squeezes spending, you're getting a lot of these lines. Look, this is manufacturing, construction, services, all pointing back lower. So we're expecting the UK economy to start to hit some pretty strong headwinds from inflationary pressures. So this gives the Bank of England a bit of a problem, because the UK are about to start, I don't know if you guys are aware, but on the 29th of March, which of course is next week, the UK effectively they trigger something called Article 50, which will then begin a 2-year process. This is where the official Brexit process begins next week, okay? And this is where negotiations are going to start between the EU and the UK. What are the Bank of England going to do about this? Because they've got potentially a nightmare on their hands. On the one hand, we've got potential economic uncertainties and risks as a result of the risk of the UK's economy being damaged as we exit the EU, but at the very same time you've got inflation ramping higher. So what do? Do they gear policy towards containing inflation, which means raising interest rates, but that's a negative for growth? Or do they say, actually, let's keep interest rates low to support growth as we get economic risk from the Brexit situation, but then risk inflation getting out of control on the upside? It's a real dilemma. At the moment, the odds, the probability of the Bank of England hiking have dropped again. This is before the data, by the way, that we received this morning. So this is probably on the back. It's probably ticked back higher now after that inflation print this morning. But it's been quite volatile. In end of January, we actually got back. We hit 50% in terms of a hike probability, but we've dropped back quite sharply now. So currently, analysts are expecting the Bank of England to prefer to remain cautious. We did get the Bank of England last week make their monthly announcements on policy, and out of the 9 members that vote to change interest rates on the Monetary Policy Committee, 8 said no hike, but 1, a lady called Forbes, voted to hike rates. And so we got a hawkish member on the committee, although she is rotating off the committee this summer. So that might be irrelevant. It might be too late for Forbes to actually gather any kind of consensus on the Monetary Policy Committee and drive through any hikes before her term finishes. This is the timeline for those who aren't familiar with the Brexit situation. This is what's going to happen. So 29th of March, Theresa May triggers Article 50. Which means that the 29th of March, or I guess the 30th of March 2019, becomes the official day where Britain is no longer a member of the EU. So what happens between now and then? What happens in the next 2 years? Well, they've got to agree on a huge number of things. Let me come back to this slide because I want to just show you this graphic, which is quite nicely sums up the EU, who's in it, who's in what. It's such a complex mess of it's multifaceted unions and zones and areas. So I would forgive you if you weren't up to speed on this, but essentially the European Union is the blue line, which encapsulates 28 countries. Those that are on this chart that aren't in the EU are Norway, Iceland, Liechtenstein, Switzerland and Turkey. They're on this chart because they're not in the EU, but they are in some of these other clubs. So Norway, for example, is part of the European Economic Area, but isn't in the EU. Turkey, well, they're in the customs union, but they aren't in the EU. Anyway, let's forget those. The UK is in the EU and will be for another 2 years and 8 days. We've got to step out of this. Now, this is a big risk economically because 40% of the UK's exports goes to EU countries, and this is free cross-border trade. It's trade that's as if it was domestic, okay? But the reason why the UK want to step out of this is about immigration and it's about legislation, because at the moment to be in this club, you've got to sign up for the free movement of people, which means that anybody from any country can go to any other country in the EU, can visit, can travel, and more importantly, can get jobs without needing a visa. So let's say somebody from France can come to the UK and get a job. They don't need a visa. They've got every right to get a job in the UK as a British citizen would. And it works the other way around, of course. So anybody from the UK, they can go to France and they can get a job. So this is what the UK have voted that we don't want anymore. We want control back on immigration. Plus, on the legislation side, a lot of laws are controlled by the European Parliament, and we don't like that anymore either, according to the electorate. And so we're stepping out of this, and the big unknown is, well, what the hell happens here economically? What happens to our trade agreement with these 28 different countries? This is the big uncertainty. If I just go back, there's other issues at play, and that is politics first. So just as Theresa May triggers Article 50, literally, let's say 5-6 weeks later, no, sorry, less than that, 3 weeks later, you get round 1 of the French election, and then a few weeks after that, you get round 2 of the French election. On the election front, we also then have Germany's election in September. So actually, these big elections from the Eurozone's 2 biggest economies are right in the way of hampering progress on the Brexit negotiation side. So that's one thing. We might get a lot of delays. The other thing then is, firstly, the EU wants to deal with what's called the divorce arrangements before they get on to then negotiating what the future deal might be. And so this is going to be acrimonious, this is going to be confrontational, it's going to be perhaps adding to risk off. There's talk the EU want the UK to pay 60 billion euros on exit, which is something the UK is definitely not going to want to do. So you might well see this negotiation start badly. I, for one, see on the Brexit risk side, risks escalating over the coming months as these negotiations start. And you know how negotiations begin. The 2 parties start on the opposite ends of the spectrum, and then they spend 2 years trying to work their way to some kind of middle ground where a deal can get done. But to start with, it will probably start badly, would be my judgment. And so that's why I think there'll be a bit of risk off, not to mention the election risk from France and Germany. Anyway, this is a bit of a timeline. So something to think about. If we just go back to the charts, just some price predictions. We've got the pound rallying as I speak, up above 125 for the first time in March. But as you can see on this weekly chart, we're kind of middle of this consolidation zone we've been in for the last 2 quarters. So the last 6 months, we've been ranging between very roughly 127 and 120, and we're still bang in the middle of that. So I would expect personally to see a bit of sterling downside, and some of that might be as a result of the dollar. So let me just maybe switch up and talk about something different here, because we mentioned Trump and Trumpflation. That was off the expectation that he would deliver a fiscal package and it would drive an acceleration in GDP and it would drive an acceleration in inflation, which is what has resulted in the Fed becoming more hawkish. So we had the Fed meeting last week, excuse me, and here's the Fed's dot plot. Sorry, let me bring that back up. Here's the Fed's dot plot matrix, which is looking at how Fed members judge where interest rates will be at the end of 2017, end of 2018, end of 2019, and then the longer run, where will interest rate levels top out in this hiking cycle. And what I've got on here is 2 sets of dots for each year, and that is the December dots. So that's the dots that the Fed put in place in their December meeting when they hiked rates for the 2nd time since the crisis. And then the blue dots, well, that's the March meeting from last week where they hiked rates for the 3rd time since the crisis. What they managed to pull off, and I have to say I'll take my hat off to the Fed and to Janet Yellen, they did something I didn't think they were capable of, and that was raising rates earlier than expected, but actually spinning it in a dovish way. I've got respect for Yellen. again, I think she's taken some time to kind of properly own the Fed chair spot and to really understand how to use markets, how to use communication, and I think she's now got it. Somehow they've hiked rates a lot earlier than most were expecting, i.e. in March, and yet still did it in a way that did not lead to aggressive dollar strength. It didn't lead to equity markets panicking and selling off. It did not lead to a sharp upside in yields. And in fact, almost the opposite. And you can see from, if I just take that slide away and look at T-notes, I mean, I know equities are selling off now, but that's not Fed related. This is about what I was talking about. That's about the risk that you're getting Trump get distracted. Ultimately, his fiscal policies, when they come, if they come, will be less significant than we thought. But look, this is T-notes. That's prices rising, so yields dropping. And that's the opposite to the Trumpflation trade. So you're getting this almost reverse of Trumpflation here as yields drop again, as risk off comes in. So when you get bond markets moving up and equity markets moving down, that's taking off the Trumpflation trade. Plus you get the dollar weakness thrown into the mix. This is all about a reversal of Trumpflation here today, and it's the biggest event we've seen on this front this year, and arguably since the election was won, actually. What's the time? Right, I'll go for another 5 minutes, and then we'll open the floor to some questions. Just the other thing to note then, because what happens now, I would say this is an important day right here. This is very important. Technically, and when I'm looking at this, I think we've had a lot of technical moves and breaches that are key. So euro dollar new high for the year. Gold making strides to the upside. Not new high for the year though, but certainly punching higher. But for the S&P, that was still trading down on the lows right now as I speak. I think any close, I think we probably will, I'd say any close below that mid-March low at 23.63, which is looking highly likely here, as we trade almost 20 points below that now and still going. I think this is going to be the most bearish candle we've seen all year. Now, this probably will set up a move back to 2300 in the coming weeks. So what's going to happen next? Now we've had this little, let's call it Trump off, if I may. Now that we've had this, what are we looking out for on the agenda in the coming days? Well, firstly, just how big a scandal is this Russian involvement, and how much of Trump's time will be spent on it, and that we can monitor by tracking his tweets, tracking them. Obviously, the media are going to be all over it. Is this going to rile Trump? Most likely. And is he going to spend most of his waking time tweeting about fake news? Probably. And so if that's the case, we'll continue to sell off. The Trump trade will continue to reverse. Add in then the final point I want to talk about. The next kind of political risk on the timeline is France. We've had, well, let me bring in a chart here. We've had the Dutch election, which went past without any major hiccups, in that the guy bottom right here, the PVV party, in the end did not follow through on what's been quite a dominant showing in the polls. This is the anti-Euro party. That hasn't happened. So look, the Dutch election's done. It's a market-friendly result. So we move on. Next up, France. So this is where we have a two-stage process, and you've got 8 candidates in the mix here who are running in the first round of the presidential race. What happens then? The winner and the runner-up in round 1 move across and compete in round 2. And almost certainly we're going to get Le Pen versus Macron in round 2. Okay? And this is the polling at the moment, and Le Pen is polling down. Actually, this has dropped slightly to 39 since the televised debate last night, and Macron is on 61. I would say it's highly likely that Macron now wins and becomes the French presidential candidate. He's a centrist from a financial sector background. He's very wealthy. He would be, maintaining the status quo with regards to France's journey, let's say, with regards to being very pro-Europe. If Le Pen wins, it would be the biggest political upset for quite some time, and I even include Trump and Brexit in that, I would say. If Le Pen wins, she wants to have she wants to move France out of the Eurozone. She wants to have an EU referendum. But I would say this is all not going to happen. And even if she did win, and here's the key point, looking on the chart on the right, even if she did, her party's only expected to win about 60 seats in the French Parliament, meaning they'll have a tiny minority, and the kind of centrist, centre-right and centre-left parties will have the big majority. So for Le Pen, if she wanted to have a referendum on the EU, well, it's got to be voted through Parliament first. It's almost certainly not going to get through. So even if Le Pen won, sure, there would be a flare-up in risk. You'd have a risk-off episode in Europe that would have a knock-on effect globally, but I don't think that would last too long, as ultimately she won't be able to do much because she doesn't have Congress on her side, or not Congress, well, yeah, French Congress. So this is the next election risk that we're looking at. Okay, just finally finishing on the charts, what do I think is going to happen? We've spoken about equities there. I might just touch on oil, which we haven't looked at yet, which is obviously a key market, and we've had a dramatic move this month for sure. We've been trapped between, let's say, $50 and $50 and $55 ever since the end of November last year, when OPEC decided or announced to cut production. So big jump up above 50, great, stable above there for 3 months, big sell-off to the downside. This is triggered by US shale producers ramping production higher, production back above 9 million barrels a day, and on top of that, uncertainty as to whether OPEC are going to extend their cuts beyond June. So this has helped to step oil back below $50, and the low point we had last week, or yeah, 14th of March, is the key price point. It's $47. Today we're making a new low as we have this kind of risk-off episode, despite the fact we had a comment from Russia about an hour and a half ago where the Russian government said it's not ruling out extending oil pact by 6 months with OPEC. So this is the idea that maybe OPEC are shaping up to extend their production cuts. When they cut production, or they agreed to in November and they started these cuts in January, the deal was we'll cut production for 6 months. Now oil's dropped below 50. We're thinking they're going to have to extend that by at least another 6 months. And this is what the uncertainty is. Russia is saying, well, yeah, we might be up for another 6-month extension, but actually, even though they've said that, you're still getting oil on the downside, and that's because we've had US inventory data, huge builds on crude, news flow that price points in terms of extraction costs for shale producers are right back down, well, not back down, right down at almost $35 now, making shale crude way more economically viable, even though price remains around the 50 mark. So, there's certainly downside risk here for crude still, until we get clarity from OPEC on whether they're going to extend their cuts or not. On the weekly chart, then, where does that put us? Because we've had a pretty decent sort of upward trend over the last, let's say, 12 months. If I just draw a line in here, and the sell-off we had start of March took us through this trend line. So this is potentially looking a little bearish. On the downside, I mean, certainly $45 is very important, and that's the end of November low when OPEC made their deal. Then, of course, you got the point, November's low at 42.20. Sorry, let me just take my trend line tool off. You got the November low at 42.20, and then $40 is big, with the summer low from last year around about that price point. Okay, so definitely looking out for Baker Hughes rig count numbers, definitely looking out for US inventory data, looking out for just how high can this production level number go, with speculation it's going to reach above 10 million barrels a day by the end of the year. Any news flow on further efficiencies being made by shale producers. This is all key, all part of the story here, but at the moment oil's on the back foot for sure. Any move below $47 should set up a move to $45 at least. Then it's about OPEC. Just how strong is the appetite to defend price on the downside? And I'd say it is strong. So I would say if we do get to $45, OPEC will agree to extend their cuts, and you'll get price moving back towards 50. Would be my judgment. Right. All right. I'm going to move and kind of flip this over onto your side. Any questions from you guys about anything? I've tried to cover a lot in a very short space of time. I appreciate I've kind of speeded through a lot of stuff there, but any kind of questions you might have, just fire away now, please.
Hi guys, feel free to start typing your questions in the questions box, and I'll ask them to Piers. What is your view, Piers, if Obamacare is overturned? What is the, I guess, the trade if it is, or the trade if it isn't?
Well, I'm sat here in London. Now, the way I would trade that, I don't trade. So just for the benefit of those here in the room listening to me, the question is, what do I think will happen if Obamacare is overturned? What would be the trade? So what we think here in London, we're very much looking at this from a macro point of view. We're not really trading US stocks, so we're not really thinking about how this might play out, let's say, in the pharmaceutical sector. What we're looking at is, just how successful is Trump at delivering policy, and Obamacare is perhaps going to be the first big litmus test of that. And what I would do is then extrapolate that out and use that evidence to gauge his ability to deliver on other stuff. Basically, we really want to see just, yes, Congress is Republican, but how much support does Trump have in that Republican Congress? And the more you get these scandals flaring up, well, then, of course, the more risk there is that Trump doesn't have the support he needs to deliver on corporation tax cuts, for example. So I would, rather than me using that as a nailed-on trading opportunity in U.S. stocks, I would look at it more as a gauge to see whether he's got the ability to deliver on policy. And the longer it takes, so the time it takes is key, because as I was showing you on that slide, how long is it going to take him to get round to delivering on fiscal stimulus? That's why markets are trading at all-time highs, and any kind of indication that his progress on Obamacare is getting bogged down, well, then that just delays the fiscal side even further, and also, of course, elevates the risk that Trump doesn't have Congress support and that he's not going to be able to deliver on other stuff. So that would generate a risk-off scenario where you're going to get equity indices sharply lower, back, let's say S&P back below 2,300 and so on. Of course, he could deliver, and if he does get repeal Obamacare, in good time, well, then that's a pretty decent statement of intent, and also a good indication he's got Congress in his pocket, and we can expect fiscal plans to come through quickly. In that case, obviously, S&P 2,400 and above. That's how I'm looking at it. That's how we, let's say, from Europe are kind of looking at that situation.
Okay, great, thank you. How do you think, or how do Trump's activities affect oil price, i.e. warmongering, stirring up international relations, his own personal business interests affect in the short, mid, and long term?
Okay, so how does Trump affect the oil price? It's quite a tricky one, this, I would say. And actually the first thing I'm going to say, and the most important thing, is actually I don't think Trump is having much of an impact on the price of oil right now. It's way more about OPEC in terms of their strategy regarding their production cuts, and it's way more about the shale industry. Now, on that side, obviously Trump is very pro the US producing as much oil as they possibly can. So you might say that Trump is, let's say, negative for oil price in so much as he's very pro trying to ramp up US production. So, however, he hasn't done anything, let's say, to help that necessarily at this point. I know he signed off on his Keystone XL pipeline, but obviously that's years away. But I would say, if anything, he's negative for price, but then you've got to throw in, forget about what Trump thinks about oil. Maybe the bigger influence Trump will have on the price of oil will come from Trump's impact on the value of the dollar. So, you know, if I were to just show you, and perhaps let me just show you the euro-dollar chart. If we look at the weekly chart, or no, not the weekly, let's look at this daily chart I'm showing you now. Now, generally speaking, we've had dollar strength, of course, since the election, although that's seriously being given back. You know, we've had, over the last couple of weeks, we've definitely had dollar weakness, which, as I was saying before, is quite remarkable given the Fed hiked in March, so well done, Janet. But I would say this Trump off trade is dollar weakness, which you might say in the medium to longer term would support commodity prices generally. But specifically, I'm not too worried about Trump when it comes to me thinking about how the price of oil is going to move. I'm way above that in terms of significance right now is OPEC and its inventory levels, as I said. So that's what I'm focusing on at this point.
Okay. Let's see. I'm trying to think of a way how to phrase this. So you would say that Trumpflation has a built-in time decay. The longer it takes him to accomplish his goals, the less of an impact overall long-term he'll have in the stock market?
Right, that's a good way of putting it. Trumpflation has a time decay. I think that's right. Let me again bring that S&P chart into play whilst I answer this, and let's just put it on a really long term. Let me just get rid of these pivot levels. So, sorry, let me just get rid of all my lines and start again here. This is obviously long term. So let's just draw a couple of lines on here. You know, certainly what's happened, obviously, since the last kind of major risk episode, start of 2016, this thing's gone through the roof, and it's been absolutely exponential since the election win. Okay, so you've got to understand where this market has come from in the last few months. Now, of course, the key question is it justified? And the longer we go, and so here's the time decay argument. The more sidetracked Trump gets with, let's say, CIA scandals, the longer it takes him to, or if indeed he's able to repeal Obamacare, well then this trade unwinds, because this trade is all about Trump delivering an acceleration in GDP growth. It's company share prices driving higher because Trump's going to deliver a huge corporation tax cut. But of course, if this isn't going to happen, let's say 2017, and if it's not going to look like it's going to happen, you know, Q1 2018 goes by and we're still bogged down, well then, you know, we really start questioning the validity of the S&P being up here. So absolutely it has a time decay, and we can easily get back to election levels, pre-election levels, let's say 2150, if by the time we get to, let's say, the end of June, Trump's progress on Obamacare is slow. Who knows? Obviously the radical can happen where it turns out that the Russians did collude with Trump's camp to rig the election. I mean, obviously that's the extreme case. So politically things can blow up. So there's certainly there's certainly uncertainty, let's say. So for sure, I don't think the S&P can stay up here much longer without continued progress being made by Trump towards his fiscal agenda.
Okay. What is the best play if it looks like Trump may be removed from office or the election was declared invalid? What's the, I guess,
All right.
nuclear option?
Yeah, okay. Well, let's talk about that. And what is the Armageddon trade? What happens if Trump gets impeached? You know, what happens if it turns out that him and his mate Vlad teamed up and rigged the election? Well, obviously, that would be nothing short of one of the most sensational episodes in history. So you're going to get some pretty wild volatility, and volatility is a word. You know, we've got volatility levels at, you know, almost record lows, so you're going to get a huge explosion in volatility. What's going to happen from the markets I've been talking about here, I would say gold looks pretty tasty in the event that you get an Armageddon scenario. And that's, you know, that's because if you look at the longer time frame, then gold sat, I guess it's kind of, it's been a bit directionless longer term. We've had decent push higher first half of 2016, almost full reversal of that as we went through into the end of 2016 after the election and so on. Now we're kind of back higher, but I would say, you know, gold up through 2016 highs for sure would be a really attractive trade, I would suggest. Also, that's one thing I would say would be a no-brainer. The other one would be US government bonds, although obviously you've got to start to go one step further than Armageddon, if that's possible, which is bringing in US fiscal risk. But I would say if you look at T-notes on a weekly time frame, then we've had a big move lower here as Trump's won the election. So there's a lot of room for safe haven upside, let's say, on T-notes in the Armageddon scenario. You might want to avoid the US though. I mean, if it is a US risk, I mean, I don't know what would happen. I mean, in that event, you know, I don't think the whole world stops rotating, but you're certainly going to get a short period of time of massive epic uncertainty on the political side, which is certainly going to damage the US economy, and that being the biggest in the world will have a negative impact globally. How long that lasts for depends on how quickly the US are able to repair that situation, install a new president. It's not like the vice president is any better than Trump, is he? So I don't know, it's a hard one to say, but I'd be all over gold on the upside. I would say T-notes would rally. I would then be looking at outside of the US, maybe looking at the yen, for example, some of those safe haven currencies, German bonds, although, yeah, I mean, if I showed you the German bond market, that might be interesting, given that we're trading down around the low end of the range for the last 6 months. So German bonds up through 2016 highs would be a good trade. And then, of course, any downside exposure you can get to equities would be very, very, very profitable. The S&P is wildly high. You know, any Armageddon, I'd say you're down to 1,800 at the very least if Trump got impeached. And obviously that's a very large distance. So any short side you can get on the S&P, be that through futures or any kind of put option exposure. Obviously if you're cash long, then you need to be hedging or getting the hell out of there. That's a given. But yeah, so gold, T-notes, short equities, and looking for some bigger moves than we've seen for, you know, in recent years, obviously.
Okay. I'm just envisioning 2008, 2009.
Right. Yeah. I don't know about that. I don't think it would be a 2008 and 2009 event, because ultimately that was driven by a collapse of the global banking system. Here, all right, you're getting a collapse of the US political system, but he's such a rogue president anyway that I don't see that creating the economic damage that the financial crisis had, actually.
Okay.
That would be my feeling.
Okay. what is your thoughts as a trader and investor on Bitcoin, and how is Bitcoin perceived in the EU?
All right, so Bitcoin, I don't have much of an opinion on Bitcoin. The reason being, it was a bit of a fad a few years back, and obviously exploded up through $1,000 and front page news on a daily basis. Then you had a lot of problems, obviously, over with the Japanese exchange and so on, and so that kind of undermined it as being a genuine long-term credible currency. Now I would say, obviously, over the last let's say the last 12 months or so, it's restored it's stabilized, it's restored its credibility to some degree. I would say, sure, it's an interesting and potentially credible alternative to conventional currencies, but I don't watch it at all. I don't think it's not very popular here in Europe as a trade. It's not something we're looking at in any way. I think it's a long-term play. I just think it's too infantile a product to really be comfortable in risk exposure to that. You know, I think it's still too new for me, and I'd rather focus on stuff that I think I can understand when thinking about the macro side of things and thinking about these major equity indices and exchange rates and bond yields and so on. You know, I prefer to stick to what I know. So I don't really have much more of a comment other than what I've said on Bitcoin.
And I'll leave it. This is the last question here. I guess as a new or novice trader, how would one go about learning more about how to trade politics, or learn how to generate a view in the market with what's going on right now?
All right. Well, that's a good question. As a new trader, how do you learn about this stuff? And I think it's very difficult. What I would say is, I mean, this is where actually Amplify have some pretty strong expertise in terms of running training programs to teach people about the macro side, but it takes time. You've got to spend time each and every day. Well, we really run a training program which essentially is a live education into macro developments as they're happening in real time. And then it just takes time, days and days and days and weeks in front of a screen watching developments impact on asset prices and starting to build up a knowledge base on how they're connected. What we do, if you ever just look at the screenshot, is you can hook into our macro side through our Trading Live virtual trading room, essentially, which hooks you into me and Anthony and others here at the office. So we're commentating on macro developments in real time throughout each day. And you get a news feed involved here, and we've got some various kind of currency tools and correlation tools and so on. So this is perhaps something to have a look at if you do want to engage more with traders and trainers on a macro level on a day-to-day basis. Then this is a good place to start. That's what I would say.
Okay, very good. Thank you for the webinar. Lots of good comments. Everyone seems to enjoy it, and as always, I look forward to it. Maybe we can do another one in the future.
Yeah, for sure. All right. Well, my pleasure talking to you, and all the very best. Thanks a lot.